I have a question for you. What is money? Do you know? Have you ever given it serious thought? We know that this piece of paper with pictures of historical national patriots and official government writing and stamps is used to buy and sell things, and that it has symbolic value. But how is this value determined? And what is it symbolic of? I mean, what does money actually represent? This question is not as easy or simple as you may think. We use paper money daily, or else we use credit. That is, if you're fortunate enough to have money or credit. It's probably the most taken for granted thing we use. And yet few actually understand what it is exactly, what it actually represents. It certainly is mysterious, isn't it? Since money is so essential to society, so ubiquitous and valuable, you'd think that monetary theory would be taught in schools. But it rarely is. Most people think that governments create money. However, that's only partly accurate. In reality, money is created by banks, which have governmental authority to print it. Still, this begs the question concerning the value of money and what it actually represents. However, in order to answer the question of where money comes from and what it represents, we should first look at how banks lend money. Well, most people believe that banks lend money entrusted to them by depositors. Once again, this is not entirely accurate either. In fact, you might be surprised to learn that banks do not create loans from money deposited, nor do they create loans from the bank's own earnings. In fact, they create those loans out of nothing other than the borrower's promise to repay. That's right. The borrower's signature on the loan papers is an obligation to pay the bank the amount of the loan plus interest, or else the borrower will lose the car, the house, or whatever asset was pledged as collateral. That certainly is a big commitment from the borrower, isn't it? Yet, what does the same signature require from the bank? Actually, it doesn't require any obligation from the bank except the magic act. That's right. The bank gets to conjure into existence, out of thin air, like a rabbit from a magician's hat, the amount of the loan, and just write it into the borrower's account. Wow, that sounds outrageously far-fetched, doesn't it? Surely it can't be true, but it is. To fully grasp how this is possible, we should know something about the history of money, for it hasn't always been created this way. Money has represented different things to different people at different times. Consider a little history to illustrate this truth. A long time ago, some ancient cultures traded things directly, without the use of money. However, eventually, money was created on the basis of precious metals, namely gold, since gold was more convenient to carry and exchange instead of things themselves. Yet, precious golden coins can be easily stolen, so people needed a way to keep their money safe. For this purpose, goldsmiths began to create vaults for people to rent in order to keep their golden coins and other valuables safe. Of course, the goldsmiths charged a fee for this service. Well, as the years went by, the goldsmith noticed that the depositors rarely dropped by to retrieve their gold, nor did they come in all at once. You might wonder why. Well, the reason for this was that the goldsmith would issue receipts for the gold, and these paper receipts were being traded in the marketplace in place of the gold, as if it were the gold itself. This paper money was even more convenient to carry than heavy coins, and the amounts could simply be written out instead of having to laboriously count one by one for each transaction. And so this was how paper money came into existence. And this was the reason why it was rarely necessary for people to remove the actual gold from the goldsmith's vault. Meanwhile, the goldsmith established another business. He lent out gold, charging interest. With the advent of the convenient claim check money, borrowers could ask for loans in the form of these claim checks instead of the actual metal. As more and more people requested loans from the goldsmith, he got an even better idea. He knew that very few of his depositors actually ever removed their gold. So the goldsmith figured he could easily get away with writing claim checks against all gold deposited in the vaults, including his own. As long as the loans would be repaid, the depositors didn't need to know what the goldsmith was doing, for they were no worse off by the practice. And that's how the goldsmith, now more banker than artisan, could become quite rich, making a far greater profit than he could by just lending his own gold. As a matter of fact, our clever goldsmith became greedy, and as he began flaunting his wealth, suspicions grew that he was spending his depositors' money. So the depositors got together and they threatened to withdraw their gold if the goldsmith didn't come clean about his newfound wealth. Contrary to what one might expect, this did not turn out to be a disaster for the goldsmith. Despite the duplicity inherent in his scheme, his idea did work. The depositors had not lost anything. Their gold was all still safe in the goldsmith's vault, but rather than taking back their gold, the depositors demanded the goldsmith, now their banker, cut them in by paying them a share of the interest. And that was the beginning of banking. The banker paid a low interest rate on the deposits of other people's money that he then loaned out at a higher interest. The difference covered the bank's cost of operation and its profit. The logic of this system was simple, and it seemed like a reasonable way to satisfy the demand for credit. However, this is not the way that banking works today. Our goldsmith banker was not content with the income remaining after sharing the interest earnings with depositors. At the same time, the demand for credit was growing fast. Nevertheless, the ability to loan was limited by the amount of gold the depositors had in the vault. That's when our goldsmith banker got an even bolder idea. Since no one but himself knew exactly what was in the vault, he could lend out claim checks on gold that wasn't even there. As long as all the claim check holders didn't come to the vault at the same time and demand real gold, why, no one would find out. This new scheme worked very well, and the banker became extremely wealthy on the interest paid on gold that did not, in fact, even exist. The idea that a banker could just create fictitious money just seemed too outrageous for people to believe, so for a while no one even questioned it. However, as time went by, the power to invent money kind of went to the greedy banker's head, as you can all imagine, and before long, the magnitude of the banker's loans and its ostentatious wealth triggered suspicions once again. Some borrowers started to demand the real gold instead of paper representation. Rumors spread. Suddenly, several wealthy depositors showed up to remove their gold. The game was up. A sea of claim check holders flooded the streets outside the closed doors of the bank. Alas, the banker did not have enough gold and silver to redeem all the paper he had put into their hand. This is called a run on the bank, and it is what every banker dreads. This phenomenon of a run on the bank ruined individual banks and, not surprisingly, damaged public confidence in all bankers. At that time, the practice of creating money from nothing should have been outlawed. But the large volumes of credit the bankers were offering had become essential to the success of European commercial expansion. Instead, the practice was legalized and regulated, and bankers agreed to abide by limits on the amounts of fictional loan money that could be lent out. Nevertheless, the limit would still be a number much larger than the actual amount of gold and silver in the vault. Usually the ratio was 9 fictional dollars to 1 actual dollar in gold. But that amount was to increase many more times in the years ahead. Regulations were enforced by surprise inspections. It was also arranged that in the event of a run, central banks would support local banks with emergency infusions of gold. Only if there were runs on many banks simultaneously would the banker's credit bubble burst, and then the system would come crashing down. Over the years, the fractional reserve system and its integrated network of banks backed by a central bank has become the dominant money system of the world. At the same time, the fraction of gold backing the debt money has steadily shrunk. Consequently, the basic nature of money has changed. As I explained in the past, the paper dollar was a receipt that could be redeemed for a fixed weight of gold or silver. In the present, a paper or digital dollar can only be redeemed for another paper or digital dollar. Furthermore, in the past, privately created bank credit existed only in the form of private banknotes, which people had the choice to refuse if they wanted to. However, in the present, privately created bank credit is legally convertible to government-issued fiat currency, or the dollars, euros, yen, or yuan we habitually think of as money, which people have no choice but to accept. However, the question remains. If governments and banks can just create this fictitious money, how much money exists? In the past, the total amount of money in existence was limited to the actual physical quantity of whatever commodity money represented. For example, in order for new gold or silver money to be created, more gold or silver had to be found and dug up out of the ground. At present, money is literally created out of debt. It's that simple. New money is created whenever anyone takes a loan from the bank. As a result, the total amount of money that can be created has only one real limit: the total level of debt. Don't you find it just somewhat disturbing that our whole monetary system is based on debt? Have you ever wondered how everyone, governments, corporations, small businesses, and families can all be in debt at the same time and for such astronomical amounts? Have you ever questioned how there could be so much money to lend? Now you know there isn't. Banks do not lend money. They simply create it out of nothing, from debt. And this debt is potentially unlimited. So is the supply of money. And the opposite is true as well. As the supply of money is potentially unlimited, so is the debt. They both feed off each other, and they are both growing and growing and growing exponentially. Isn't it astounding that despite the incredible wealth of resources, innovation, and productivity that surrounds almost all of us, from governments to companies and individuals, we are also heavily indebted to bankers? If only people would stop and think, how can that be? How can it be that the people who actually produce all the real wealth in the world are so indebted to those who merely lend out the money that represents the wealth? Even more amazing is that once we realize that money really is nothing other than debt, we likewise realize that if there's no debt, there's no money. What can we do about this downright scary situation? For one thing, we need a very different concept of money. It's time more people ask their governments 4 simple questions. First, why do governments choose to borrow money from private banks at interest when a government could create all the interest-free money it needs itself? And the second question is, why create money as debt at all? Why not create money that circulates permanently and doesn't have to be perpetually reborrowed at interest in order to exist? The third question is, how can a money system dependent on perpetually accelerating growth be used to build a sustainable economy? Isn't it logical that perpetually accelerating growth and sustainability are just incompatible? And finally, what is it about our current system that makes it totally dependent on perpetual growth? I mean, what specifically needs to change to allow the creation of a sustainable economy? Well, at least I hope that now you are starting to question the global monetary system. Objective critical inquiry is certainly a good starting point if we want to get to the root of the problems surrounding the global finances and the global economic system. Moreover, since the financial crisis of 2008, the global financial system has proven itself to be unstable, exposing some serious, perhaps fatal flaws that have, as of yet, not been addressed structurally. It seems as if the system is unraveling, and now we know why. Like the emperor who strutted about without clothes on, the current monetary system is based on an illusion. Isn't it about time that people wake up and shout aloud that the foundation of this monetary emperor is naked? Or will we wait for another global economic crash before we realize this fact? At that point, it could be too late to do anything about it. Who will gather the courage to shout, "But it's based on nothing. The clothes it has on are now ragged and falling off"? So I ask you, isn't it about time that we rethink our monetary system to establish it on a firmer, more sustainable foundation than ever accelerating debt? Think about it. Do something about it. Thank you for your attention.